Yeah, there we go. I do have a bill request, and it's RS 0787, and this would be on behalf of Russell County, and it would authorize local sales tax election in Russell County.
Committee, any questions? Any objection? Seeing none, we'll make the request. Thank you. Next is Senator Clays. Welcome.
Thank you, Madam Chair, and members of this committee. My name is Senator Clays, representing District 27 in Sedgwick County, and I am here to request the introduction of 25 RS 0788, a bill concerning the sales tax of firearms.
Any questions, committee? Any objection? Seeing none, we'll make the request. Thank you. Karen, welcome to the Tax Committee.
Good morning. I'm here to request a bill RS 1004. This is to allow tax deductions on gambling losses.
Committee, any questions? Any objection? We'll make the request. Thank you, Karen.
Can you have her say her full name?
Karen Emerson. They wanted your full name. Is that Karen Emerson? Would you mind stating it for the record? Yeah.
Sorry, Karen Emerson. I'm from Chinook, Kansas.
Senator Owens.
Thank you, Madam Chair. I would request for introduction 25 RS 1006 on behalf of Leading Age Kansas. This is a healthcare preceptor tax credit.
Thank you, Senator. Any questions? Any objection? Seeing none, we'll make the request. Senator Corson.
Thank you, Madam Chair. I've got an oldie, but I think it is a goodie. They're still doing great work in our community. I've got 25 RS 0857. This is a sales tax exemption for the Johnson County Christmas Bureau. I also want to introduce my page. Ben, can you stand up, please? Got Ben Wymore paging for me today. Ben is a 5th grader at Briarwood Elementary in the Shawnee Mission School District, so really glad to have Ben with me today at the Capitol. Thank you, Madam Chair.
Thank you, Senator. Welcome, Ben. And committee, is there any questions for Senator Corson? Any objection? Seeing none, we'll make the request. Senator, we were so close on that bill last year. Maybe this year is the time. So, Senator Peck.
Thank you, Madam Chairman. I do have a bill introduction, but before I do that, I have a couple of young men from Oswego High School in southeast Kansas who are serving the Senate as pages. Miles Deeker and Brandon Wary, a junior and a senior, and you won't guess which is a junior and which is a senior. But gentlemen, good to have you with us. Thanks for being part of the process in the Senate today. Now, as far as a bill introduction, Madam Chairman, I have a bill that would require counties to purchase homesteads for the appraised value if the homeowner is willing to sell the property. The RS is 0624.
Committee, any questions? Any objection? Seeing none, we'll make the request and welcome to the Capitol. Committee, let's turn our attention to the hearing on Senate Bill 109. Amelia, will you give us an overview?
Good morning, Madam Chair, members of the committee. Senate Bill number 109 relates to sales and compensating use tax and would provide a remittance credit to retailers in an amount equal to 1.5% of such remittance. The total credit amount for each month would not exceed $300 for each retailer, and the bill would take effect from and after publication in the statute book. And I would be happy to stand for questions.
Committee, any questions? Seeing none, thank you, Amelia. Our first conferee is Chris Arnold. Welcome to the Tax Committee.
Good morning, Chair and members of the committee. I am Chris Arnold, owner of River City Brewing Company in Wichita. I'm here on behalf of myself and the Kansas Restaurant and Hospitality Association in support of SB 109 because it in part recognizes the expense we incur collecting taxes for the state of Kansas. Several forms of hard costs required to collect taxes for the state of Kansas. Direct credit card fees and indirect administrative burdens that require increased levels of training and point of sale processing knowledge. So if I begin with this direct credit card fees, I pay an average of 2.78% in fees to the credit card company every time somebody swipes a credit card at the brewery. So that's obviously paid on the sales tax I collect. A few points of data to consider when thinking about the cost of collections we incur. In my store, credit cards were used 89.5% of every transaction. If we remitted to the state $100,000 in taxes, I would pay $2,780 to the card processor to process that fee. If I remitted to the state $300,000, I would pay $8,340 to the processor. It's really just a very simple math formula. On top of direct expenses, we have administrative burdens. The committee has removed several of those over the years, and I certainly appreciate not having to advance the state my cash flow. However, many of the burdens are fundamental to our processes to make sure our reporting and remittance is appropriate. Basically, I pursued a career in food and beverage and making craft beer, which I enjoy, and I have a fantastic job. What I didn't want to be necessarily was a tax collector or accountant. SB 109 provides a retailer a small benefit, obviously of up to $300 a month for collecting the state's tax. We'd take more if you saw fit. In my store, it's about $7,500 I spent in fees last year. When I was thinking about that number, I have a 19-year-old daughter. She's a freshman at Wichita State University, and that fee would pay for a year of her college at Wichita State. It's a very real number, and it kind of hits home. The state chamber included in their testimony a summary of the ways other states provide a measure of equitable relief that I would encourage you to review. And then in addition, there's a study from the state of Washington analyzing the issue that we have presented in the past. So guys, to conclude, SB 109 is a reasonable way to think about the collection burdens and costs placed on retailers to collect Kansas taxes. Thank you all so much for hearing me out.
Thank you. Committee, any questions for Chris? Seeing none, thank you, Chris. Don McNeely, welcome to the Tax Committee.
Good morning, Madam Chair, members of the committee. I am Don McNeely, and I'm president of the Kansas Auto Dealers Association, and I'm pleased to appear in support of Senate Bill 109. As the chairman and I were talking earlier, I don't know how many times I have talked to this issue over my 34-year career here in Kansas, but I'm glad we get to have this conversation this morning. The franchise new car dealers, they're essentially responsible for 20% of the amount of sales tax collected in the state of Kansas. We fluctuate, depending upon the year, from 17% of the amount of sales tax collected to about 22% of the amount of sales tax collected. In 2023, the Kansas dealers collected $556 million in sales tax on annual sales of $7.5 billion. You know, not only are the dealerships responsible for collecting and remitting the sales tax, but they also have to have a very good working knowledge of the complicated sales tax rules and regulation as it pertains to the sale, lease, as well as the service of motor vehicles. The sales tax rules and regulations as it pertains to motor vehicles is a lot more complicated than, say, buying a garden hose. I mean, the dealers spend a lot of time understanding the state's rules and regulations. Sometimes, even though we're not supposed to be the sales tax police, the dealerships find them in that position of being the sales tax police. And no one likes to pay sales tax, and they have to be cognizant of what exemptions do exist, what exemptions don't apply to vehicles, et cetera. When I first got here from Illinois, I was surprised by the lack of sales tax guidance in regards to motor vehicles and I requested numerous letter rulings through the Division of Taxation. And after compiling all those written letter rulings about 15 years ago, Richard Cram and I sat down and we put together a guidance manual. And if you ever have an opportunity, pull up a publication KS 1526, and there's 15 pages of detailed sales guidance as it pertains to the sale, lease, as well as service of motor vehicles. As the previous individual mentioned, there are a lot of states that do compensate retailers. They're all over the board. Some states have caps, other states do not have caps. Some states, the dealers do not collect sales tax on the sale of motor vehicles. Nebraska doesn't, Oklahoma doesn't, Missouri doesn't. But Missouri is going to start the dealers in Missouri are going to start collecting sales tax on vehicles in July of 2026. Missouri retailers get 2% of what they remit with no cap. Again, I appreciate the opportunity to provide some comments in support of Senate Bill 109, and I'd be more than happy to answer any questions the committee might have this morning.
Thank you, Don. Committee, any questions? Senator Schallenberger.
I thought we did pay. Have we passed bills before to do this? And
Yes, and they've never gone into law.
so, okay, thank you.
I think, as Don said, it's been discussed way before I was ever here. And
I remember, I think, Senator Joe Wagner. I mean, when she chaired this committee, I spoke to the bill, and that's been, I don't know how long ago that's been, Senator. And I know that Senator Donovan we heard that bill when he was chair of Senate Tax as well. And Chairwoman Tyson, I know at least twice, 3 times that this bill has been in front of this committee. I just think it makes sense to compensate the retailers in the state in terms of their administration.
Senator Peck.
Thank you, Madam Chairman. Now, Mr. McNeely, if one of the automobile dealers sells an auto to an out-of-state resident, they do not collect any sales tax. Is that correct?
No. But we have to make sure they are in fact a resident of another state. Division of Taxation has been very focused over the last couple of years in going through the ST8B. That is the form that an out-of-state resident has to acknowledge that they are in fact a bona fide resident of another state in order for the dealer not to collect sales tax on that transaction, Senator.
So if the Kansas legislature were to remove the responsibility of dealers collecting sales tax, it would free up additional resources for every single dealer, because then when the vehicle is titled at the county could collect the sales tax. Does that make any sense? Is that something that
That's what some other states do. I believe that's what happens in Oklahoma, Missouri currently, Nebraska. Of course, Oklahoma, as you probably know, being close to the state line, they have, I think, what they call title agents that they can process transactions other than the county treasurers.
The reason I ask these questions, Madam Chairman, it would reduce the fiscal note on this bill if we didn't ask our dealers, and it would also provide an additional incentive, because I just purchased a vehicle last year out of state because I saved significant amount of sales tax by only paying the state portion versus buying it in Independence, Coffeyville, Parsons, Wichita, etc. So I just thought that I would throw that out as a possibility that we may want to look at. But I think it directly relates here because it would reduce the fiscal note, would free up our dealers to focus on selling automobiles rather than collecting sales tax. Thank you, Madam Chairman.
Thank you. And that is a result of destination sales tax on many of those. Senator Owens.
Thank you, Madam Chair. I might throw just a little complexity in there, only because I was testifying this morning in transportation over the titling of non-highway vehicles. And actually, we are required, even though we are a new and used vehicle dealer, Kansas doesn't have a specific carve out for power sports only. We're a new and used vehicle dealer. We have to collect sales tax at our dealership regardless of where the purchaser originates. So different than what an automobile dealer, we're collecting sales tax all the time. So that what I'm saying is a new and used vehicle dealer is not only selling highway vehicles, they also sell other things that have a different set of requirements.
Senator, that's an excellent point.
Senator Schallenberger.
Okay, so let's see if I understand this. Senator Peck, include me in here. So if I go to Missouri and I buy a car, they give me the paperwork and I go to the county treasurer and I will pay state, county, and city, the city in which I live,
Yes.
sales tax on it.
That's correct.
If I go to Columbus and buy a car, which is, we try to buy our cars in state, Senator Peck.
We appreciate that.
From Hatfield up there, Hatfield, the car dealer. I will only pay the Columbus tax on it. I won't pay the Baxter tax.
Not unless the Baxter tax is higher.
It is higher.
Okay, then you would be charged.
Well, I'm still going to pay the same. If I buy it in-state,
Right.
I'm going to pay everything.
Yes,
And if I buy it out-of-state, I'm just going to pay,
whatever it is where the vehicle is going to be garaged or
pay
registered.
the same no matter what.
Yes. Well, it just depends.
What?
Well, say that you went to Columbus and the total loads, state and Columbus sales tax is, say, 8%. And then you take it to Baxter and their total is 9%. Baxter would collect the additional 1% at the point of registration.
And okay.
Right. And if you remember, the reason that was done was because people were shopping sales tax in the state of Kansas. They would vote for a sales tax increase, and then when they got time to buy a vehicle, they would go shop sales tax to avert the sales tax.
So there's no advantage. I mean, there was a time in Wichita everybody moved outside the city limits
Right.
so they could
Right.
advertise.
Right.
You're not avoiding anything by going there.
No, because of that hybrid destination sourcing rule we passed, that got rid of that issue in the state of Kansas. But what Senator Peck was referring to is that I don't think that his local community has any local tax. Right, it does not. So only thing he would pay is just the state-based sales tax rate.
When you pay your sales tax, when you purchase the car.
Right.
So I've gone to Columbus and Hatfield sold me a car.
Right.
Then he can also include that in the financing.
Exactly.
And so it may get paid a little quicker.
Well, no,
If
that's.
the dealer collects it, than if we send Mary off with her paper tag and she never tags it.
Yeah, no, that's an excellent point, Senator, because, average sales tax in the state is getting close to 10%. And the average price of a new vehicle is now $49,000. So that's $4,900 plus you get your property tax. I mean, the vehicles in the state are carrying a huge tax load, and most of the time, in terms of new purchase, they are financed into the purchase price.
Thank you.
So coincidentally, committee, I know Eddie's not here today, but one of the things I've requested from research for this committee to go over is vehicle taxes and property tax. We will be having an informational hearing on this. So I'm going to draw us back in on the bill, but Senator Owens, did you have a question?
I was only going to add, based on what Don was saying, that it doesn't work in reverse. For example, I bought a vehicle in Saline County, and it was 9% sales tax. But when I went to register it in Harvey County, where we have 8.5%, I certainly didn't get my 0.5% back. Right. So just remember, it kind of works one way and not the other.
Yes,
Thank you.
Good point, Senator. And
Any other questions? Seeing none, thank you, Don.
well, thank you very much. Appreciate it.
Good discussion. Our next conferee is Dan Murray. Welcome.
Yeah, thank you, Madam Chair, members of the committee. My name is Dan Murray. I'm the Kansas State Director for the National Federation of Independent Business. Represent almost 4,000 small business owners from all across the state. I can affirm that this is, I think, my 17th year in this role, and we've talked about it every year, and it's been a priority for small business owners. The Washington study that was referenced by Mr. Arnold, there is a link on my PDF. I could also provide it to you afterwards if it's not included in someone's testimony. But in effect, it does demonstrate that small businesses disproportionately pay more in terms of the the cost of complying with the remittance of sales tax. This isn't about lining the pockets of retailers or small business owners. It's about compensating them for what they do on behalf of the state to collect sales tax. That's pretty simple, and we've talked about the other states, particularly those that surround us that allow for this, and we would like to have the same benefit as well. So with that, Madam Chair, I'd stand for questions.
Thank you, Dan. And would you mind emailing that to John so he can distribute the link?
will.
That would be great. Committee, any questions for Dan? Senator Corson.
Thank you, Madam Chair. Thanks for being here, Dan. So my question is really, I'm not at all opposed to this from a policy perspective, but it is quite a substantial fiscal note. It's over $60 million a year. And so I'm just trying to get your sense as somebody who represents small businesses generally. Is this sort of the highest and most significant priority for the NFIB members? And this is where, if we are going to do tax relief in this vein, that it should go? Because, I mean, $60 million is quite a price tag. It's $60 million in residential property tax relief we're not able to provide. So I'm just trying to get you to kind of discuss where this fits in terms of priorities for your members, because I don't disagree with the policy, but the price tag is pretty substantial, and I think this committee is going to have to make some hard decisions in that vein. So thank you.
Madam Chair, Senator, that's a fair question. It's hard to prioritize. I mean, I think certainly when you look at the problems and priorities of small business owners through our various studies and surveys, income taxes, cost of compliance to income taxes, property taxes rank up there among those. The cost of health insurance is the #1 issue for small business owners for over 30 years. But this is something that they prioritize, particularly those that are more in the retail space, the restaurant hospitality. I'm not giving you a good answer, but we would like it all.
I appreciate the honesty. Thank you, Madam Chair.
Senator Peck.
Thank you, Madam Chairman. We have in the past, Mr. Murray, had legislation that excluded big box stores, and not to pit you against big box stores, but I know that NFIB is voice of small business. Would that be something that you think would help get this legislation through if we helped the little guy, the smaller business owner, by this legislation and excluded the big box stores?
Senator, that's another good question. And I know in other states, I think by capping it, you kind of impact that fiscal note in terms of the volume that the larger retailers have. But certainly for small business owners, they don't have in-house accountants. They have, the disproportionate amount of cost to implement the collection of that. Whereas, the big retailers, they have systems and on scale can comply with it a lot more easier than small business owners. So I think that's an option that would be maybe on the table to consider, to maybe direct the benefit of this policy to those that are most directly impacted, which in this case I think is the small business owners.
Thank you, Madam Chairman.
Thank you, committee. Thank you, Dan.
Thank you.
Committee, our next conferee is William Wilk. Welcome.
Good morning, Madam Chair and members of the committee. My name is William Wilk, Senior Director of Government Affairs for the Kansas Chamber of Commerce. The Kansas Chamber represents small, medium, and large-sized businesses across the state advocating for policies to improve the economic climate in Kansas. The Kansas Chamber is also the state affiliate for the National Retail Federation, and on behalf of the Kansas Retail Council, we appreciate the opportunity to submit proponent testimony on Senate Bill 109. Our advisory board for the Kansas Retail Council is made up of both multi-state large retailers as well as the small independent retailers across the state. One issue that the Retail Council has expressed in support of for many years is the credit on the amount of sales tax that is paid in the state. And currently, attached to my testimony, there are 30 states that offer some form of relief to offset the cost associated with collecting sales tax remittance. Senate Bill 109, as you know, offers up a $300 per month credit with a cap of 1.5% of total remittance to the state. How states manage this varies. But most offer a fixed dollar maximum either per month or annually For example, Alabama has a $400 a month maximum, has a 5% rate on the first $100, but 2% on anything over $100. And Arizona has a 1% credit capped at $10,000 annually. In doing my research, I thought it was important to note that the Kansas Department of Revenue currently has an agreement with Missouri, Oklahoma, and Nebraska to provide discounts to offset the costs of collecting and reporting another state's tax. Those discounts currently in effect are Missouri at 2%, Nebraska at 2.5% up to the first $3,000, and then tax remitted per month for the maximum discount of $75, and Oklahoma at 1% of their total discount limited to $2,500. There's no right or wrong approach to this. However, we ask the legislature to acknowledge the role private industry plays in serving as the state's tax agent and supporting policies that help businesses offset software and other costs associated with compliance. Thank you for the opportunity to testify today in support of Senate Bill 109, and I'm happy to answer any questions at the appropriate time.
So thank you, William, and I would thank you for the data from the other states. That's interesting to see. Committee, any questions? Senator Corson.
Thank you, Madam Chair. If I could kind of pose a similar question to what I posed to Mr. Murray. Again, I think this is a good idea from a policy perspective. I think where we are, we're going to have to leave some good ideas on the cutting room floor. So I'm trying to get your sense of where you and the chamber as the business community would prioritize this, because I know there are a lot of other ideas out there. So I'm just trying to get a sense of sort of where this fits in terms of priorities. And thank you, Madam Chair.
Well, similar to Mr. Murray, I mean, we would like it all, but definitely we hear from income taxes from our members more often. But I know with the Retail Council, this has been an issue for several years, and they would like to see this accomplished finally.
Senator Peck.
Thank you, Madam Chairman. I appreciate your testimony, Mr. Wilk. I'm sorry, paragraph 4, I'm not following. The Department of Revenue has an agreement with 3 states, neighboring states, and you list some dollar amounts. Who actually gets the money? Is it the state? Is it a retailer? Kansas retailer, now state retailer? I'm sorry, I like that information. I just didn't understand it.
Yeah, to my understanding, it's the out-of-state retailers, and there's a PDF that I found that it's actually on that website with that article, and it takes you to the Department of Revenue's website, and then you can access the PDF there, and it says that the Secretary of Revenue is able to make agreements with other states for collecting sales tax remittance.
So there is money being paid to other states, Kansas tax dollars, for collecting sales tax. Is that a simple way to say it?
That's how I understood it, yes.
Thank you, Madam Chairman.
I think we'll need to get clarification on that from the department. When we do the sales tax overview, if they would, we'll look into that. So committee, are there any other questions for Mr. Wilk? Seeing none, thank you. I am going to request from Eric, Senator Peck brings up a good example on the sales tax on vehicles. I think the fiscal note would be help this bill, but I think it will be negatively impacted. But I think the committee should explore if the sales tax was paid at the county instead of at the dealer. Would that be what you were looking for, Senator Peck? Okay, thank you. So we'll make that request. Committee, that is all the conferees, the proponents. Is there anybody else that would like to testify as a proponent? Any opponents? Any written or neutral? No other conferees. I'm going to close the hearing on Senate Bill 109. And we do have a briefing committee on from Legislative Post Audit. I think it will be an eye-opener for some of our members. Josh, I've seen this I don't know how many times, and you did an excellent job on this audit. Thank you.
Thank you, Madam Chair and members of the committee. I am Josh Luthai, an auditor with Legislative Post Audit. As the Madam Chair said, I've given this presentation a few times, so apologies if you've heard it before. I will try to keep it interesting. I'm hopeful that you will have a memo available to you from me. It should look something like this without my scribbles at the top of it, but that's what I'm going to be working off of if you'd like to follow along. So For the past few years, state law required my office to review economic development incentive programs on a recurring basis. It also required us to evaluate all new incentive programs the year after they were created. Those requirements have changed a little bit recently, but what I'm going to be talking about today with you all are some of the outcomes of the evaluations that we did in 2023. I'm going to be talking to you about the High Performance Incentive Program, or the HPIP program, which we evaluated in 2023. It was not a new program. And then I'll also be talking about 2 state housing tax credits that the legislature created in 2022. So also, we did these evaluations in 2023, so some of the data I'm going to cite is going to be a little dated at this point. I'm going to start out with the High Performance Incentive Program. Again, that is the HPIP program. HPIP provides businesses 3 potential tax benefits. The first is a tax credit equal to 10% of the business's qualifying capital investment. That tax credit can be carried forward for up to 16 years, which means if a business doesn't have enough tax liability to use that credit in 1 year, it can try and use that credit again in future years for up to 16 years. Secondly, a business may receive a sales tax exemption on goods and services related to its capital investment project. And finally, a business may receive a tax credit that matches its expenditures and training for employees. That credit is capped at $50,000 per year, and it cannot be carried forward. In terms of program administration, both Commerce and KDOR have a hand in this program. Commerce certifies that businesses are eligible to participate in the program, and then KDOR administers the tax benefits by doing things like processing tax credits and giving out sales tax exemption certificates. This program was created in 1993 and has no sunset. In terms of how the program has been used, in tax years 2018 through 2020, businesses were awarded more than $3 billion in HPIP tax credits. Most of those businesses were located in a few counties like Johnson County, McPherson County, Sedgwick, and Wyandotte. And that $3 billion, I should clarify, the fact that businesses were awarded those credits doesn't mean they actually used them. That's a concept I'm going to come back to here in a couple minutes. In terms of our evaluation, we estimated the return on investment that we think the HPIP program might produce for the state over the next 20 years. We looked at both the economic impacts of the program and its fiscal impacts, which in other words is its sort of effect on the state revenues. For the economic impacts, we estimated the HPIP program will generate about $3 in economic activity for every dollar in tax revenues the state gives up. However, we also estimated the program will generate about 35 cents in tax revenues for every dollar in tax revenues the state gives up. So what that means is with this program, we're thinking that the state gets about $3 in economic activity for every dollar in tax revenues it gets up. But the program doesn't pay for itself because it only creates an additional 35 cents in tax revenues for every dollar the state gives up. So there's about, what, a 65-cent deficit there. Whether that's an acceptable return for the program is a policy decision for you all. And there were a couple issues that I did want to note that do affect our evaluation. One of those is the issue I kind of mentioned earlier with the fact that businesses don't necessarily claim all the credits they get in a particular year. And that is that the 16-year carry forward makes it difficult to know how many HPIP credits a business will claim and when they will claim those credits. We did notice that in the data that we reviewed, businesses tend to claim many more credits than they actually use on a year-to-year basis. So for example, in 2019, I believe, businesses claimed or were awarded about $913 million in HPIP credits, but they only used $88 million of that amount. That is, they carried the rest of it forward and can continue to do so for the next 16 years. So it's really hard to say whether businesses will ultimately have enough tax liability to use all their credits. If they do, that could be a cost for the state. If they don't, then less of a cost for the state, and that does affect, the estimations as to how this program is going to affect the state. I will note also in the 2021 session, the legislature amended the HPIP program such that for projects that are placed into service after January 1st, 2021, the businesses involved with those projects can transfer up to 50% of the capital investment credits they earn on those projects to another entity, and those entities can then use those tax credits. So in the past, my understanding is the HPIP program, the credits were not transferable. This makes them partially transferable, which may make it more likely that those credits are claimed, which could in turn increase costs to the state. Would you like me to pause for questions after each program or just go through all the programs?
No, let's pause after each program. And I I've made a request. The committee will be getting the information. I'd like to know where that tax credit bill, what committee it went through, because I know it didn't go through tax. So, committee, any questions? Senator Clem.
Thank you, Madam Chair, and thank you, Josh. So just so I understand kind of what you're saying, for every $3 that we'll generate $3 for every dollar that we give in tax incentives.
Yes.
Is that fair? And we only generate 35 cents of it as a result of that dollar give. So that's the 65 cents you're referring to.
Yes.
Does that take into consideration surrounding businesses that may surround that group that is getting that incentive? So there could be some additional benefit that we're not seeing in this, or does that take that into consideration?
I believe the model tries to take that into account. We talk about that a little bit at the bottom of page 1 and top of page 2 of the memo. The model we use does try and take into account both direct and indirect economic effects. So I think that's kind of the spillover effect you're talking about.
Yeah, it is. Yeah, that's helpful.
So, any other questions? Senator Schallenberger.
Yeah, the same thing. I'm curious about that, and I think I understand. So we put $1 into the program. That program itself spends a little economic activity and does $3 worth of activity. But the tax that activity brings in is only 35 cents.
Correct, yes.
So it may be a benefit to somebody, but it sure isn't a benefit to the state. It's a cost to the state.
Yeah, so I think a question for you all is whether it is acceptable for an economic development incentive program to cost the state more than it returns in tax revenues.
We're told every time we do one of these that it's going to, there'll be all these jobs, and they're going to, all this manufacturing, and we're going to have all this construction, and we're going to, and it never seems to happen. And I think I think it does happen, but less than it costs us to go for it. Thank you. That's my question.
Thank you. And I'm going to ask, I'm going to, not from post audit, but from research. And so we had a bill last year, committee, if we would sunset the HPIP program, how much could we lower corporate income tax? Because this is going to corporations. So I think this committee should take a look at that again this year. And I guess we can do it in matter of a bill or an informational hearing, but I'll work that out, committee, so that we can take a look at it. Any other questions on HPIP? So do we know how much, I know a lot of these tax credits were not being used, but when the transferability went into place, do we know how much is being used since that change in legislation?
I cannot tell you that, Madam Chair. I believe you asked a similar question, though, back in November 2023. We did reach out to Revenue at that time, and they told us there were more than 900 million credits that could be carried forward at that time. I don't think that answers your question, though, as to the extent to which they've been used.
Thank you. Thank you. Thanks, Josh.
I will move along then to the affordable housing tax credit. That's going to start at the bottom of page 2 of the memo. In 2022, the legislature created the Kansas Affordable Housing Tax Credit. That is a tax credit that matches the federal low-income housing tax credit. So we have the federal low-income housing tax credit and the state affordable housing tax credit. I'm going to refer to those as the federal and state tax credits moving forward because they're really long to say otherwise. But both of these tax credits are administered by the Kansas Housing Resources Corporation, or the KHRC. And state law directs the KHRC, when it allocates the federal tax credit to a housing development, it should also allocate a matching amount of state tax credits. And KHRC allocates these credits to rental development projects that are targeted toward low-income individuals. The idea is the KHRC gives some tax credits, say $1 million, to a developer, and that developer awards those credits to investors to attract investments to its project. This essentially subsidizes the creation of more affordable rental housing for tenants. Now, getting into page 3, this is where things get a little complicated because of kind of how the tax credit works. It essentially has a stacking effect, which is when the KHRC allocates an amount of tax credits in 1 year, the individuals involved in the project that got that tax credit get to claim that amount of tax credits every year for the next 10 years once the project is placed into service and occupied by tenants. So to put this in concrete terms, let's say I'm a housing developer and I get $1 million in credits from the KHRC. I'm going to give those credits to some investors so that I can build my project. Once I've built my project and I've got tenants in the housing project and I'm complying with program rules, my investors are going to start claiming $1 million in tax credits every year for the next 10 years. So 1 year of $1 million allocation generates $10 million in potential foregone revenues to the state over the next 10 years. KHRC will go through this process again the next year. And if we say they allocate another $1 million, that's another $10 million over the next 10 years for a total of $20 million over roughly 11 years so far. Talking about it gets a little complicated because of that stacking effect. But if we put this in the context of how the program has actually been used in recent years, the fiscal effects to the state could potentially be significant. This is going to be middle of page 3 in the memo. In 2023, the KHRC awarded about $25 million in tax credits to about 24 housing projects. And like I said, because those credits get claimed every year for 10 years, that's about $251 million in foregone tax revenues, potentially assuming investors claim all those credits. I did look earlier, and it appears KHRC awarded another $25 million in tax credits in 2024. So that's another $25 million stream of tax credits for about $500 million in potential foregone revenues over the next roughly 11 years, depending on how and when investors claim their credits. So the long-run costs of this program could be significant to the state. And that is because there is no state cap on this tax credit. The federal government caps the amount of federal tax credits that KHRC can allocate, but that cap is $28 million per year. So the KHRC could potentially allocate as much as $28 million per year. One of the things we noticed with other states that have a similar tax credit is they tend to put a cap on their state tax credit that is lower than the federal cap. For example, Oklahoma caps its state tax credit at about $4 million a year, which would limit its potential foregone revenues to roughly $40 million a year once the program is up and in full swing. So that was the issue we wanted to bring to your all's attention in case you wanted to consider imposing a cap on the state tax credit. I will pause at this time for questions.
Thank you, Josh. And there's actually a bill in the House to repeal this program, not just cap it. Senator Schallenberger.
So to get the tax credit, how much do you have to invest? I'm assuming there's a minimum investment requirement or an investment requirement. The builder, is it a 10%, 35%?
I do not believe there is a minimum investment requirement. I think.
Is the tax credit a percentage of the investment?
No, the tax credit is a flat amount. So developers are going to engage in a competitive process with KHRC to try and get KHRC to award them credits. So they're going to make commitments to do various things, like offer certain amenities or commit to other things. And then KHRC will award credits to the projects that it thinks are going to best serve Kansas. And then within the project, they will decide how to distribute those tax credits.
I want to build 4 duplexes and put a pool in and whatever. I go to KHRC. I try to get a credit. They give me $500,000. And then I get to, does the builder get the credit?
Generally speaking, I believe the builder
and then he can
hands that
sell it?
credit out essentially to investors, yes.
And then next year, the builder gets it again, he can sell it again, is that?
My understanding is the credit gets allocated upfront and then it stays with the individual investors.
And if the investor doesn't have that much tax liability, then he can sell it, right?
The credit is not, as I understand it, transferable, so it stays with the investors and then they can carry it forward for up to 11 years in case they can't use it in 1 year.
Okay, that's interesting. Thank you.
So I'm going to call on Amelia to confirm, but it is non-transferable.
Madam Chair, I believe it is non-transferable in the sense that most of you would recognize language of transferability in tax credit statutes. This requires investors to participate in the project, become investors in the project to obtain the tax credits.
So the same investor pool then keeps the credit, gets the credit. So you go get some banks or people that really can use the tax credit. Okay, thank you. Creative.
And it's a sweet deal too, because I know you're giving $1 million example, but would you apprise the committee of where we're at fiscally on this right now?
Do you mean how many credits have been awarded so far? In 2023 and 2024, I believe KHRC awarded about $25 million each year. I don't know what they've done so far for 25.
One was 25.1 and 26.3 approximately, yeah. Senator Clump.
Thank you, Madam Chair. The 4 million cap in Oklahoma, do you know if that's driven on a formula or what drives that? I think you said there's a $4 million cap per year with Oklahoma.
For Oklahoma, I'm not aware of a formula they use. I think it's just at the state's discretion of how much they want to
Arbitrary
limit their
number they pick.
liability, essentially.
Thank you.
So I guess that what the question would be, the 2023 and the 2026, how much of that overlaps? Because if we're looking at $250 million, 10 years out, so is that 260 million that was issued, or is that overlapping the 250? I mean, we need to understand that because we could be looking at over 500 million right now.
Yes, there is some overlapping. There are a lot of moving parts, which makes it complicated to explain. It's almost easier to like draw a picture almost, but if we assume that a housing project is instantly built and occupied, which generally takes a few years, but just for the sake of example here, if we assume those things happen instantly, $25 million in year one, investors start claiming those every year for the next 10 years. So $250 million, let's say, over 10 years. In year two, let's say there's another $25 million. So that's going to be $250 million over the next 10 years, 9 of which overlap with the year one allocation, but it's going to be roughly $500 million total over 11 years, and then $750 million over, I think, 12 years, and so on and so forth. I think I did my math right.
So the terminology that was used in the Commerce Committee, this could, and in your report, literally could bankrupt the state if this is not reined in.
I would say the fiscal impact could be significant. I won't speak to what it could potentially do.
Okay, okay. Committee, any other questions? Thank you, Josh.
And then finally, I will be brief here. We have the housing investor tax credit. This is at the bottom of page 4. This is also a tax credit that the KHRC administers. Under this program, KHRC allocates tax credits to housing projects in counties with populations of less than $75,000 to help incent the development of housing projects in those states. This tax credit is mutually exclusive with the tax credit I just talked about, so you cannot get affordable housing tax credits and housing investor tax credits. And this housing investor tax credit, it can also be for either rental or owner-occupied housing projects. Unlike the affordable housing tax credit, this tax credit does have a cap. KHRC can only issue up to $13 million in credits per year, and taxpayers can only carry this credit for up to 4 years. However, this credit, unlike the other one, is transferable, and it has no sunset. In terms of how it was used in 2022 and 2023, KHRC allocated about $20 million in credits to 41 projects. Those projects were both rental units and owner-occupied units. And when we were doing our work, KHRC told us they planned to allocate about $6 million in additional credits, but it's unclear to us what they've done since then. And it doesn't have any strange or confusing mechanics like the one I just talked about, so I will leave this one there.
So thank you, Josh. On this one, and we ran into problems on previous programs too, the interpretation by the secretary, is the 13 million the actual cap that it has to decrease before anything else can be awarded, or are they awarding $13 million per year?
My interpretation would be it's $13 million per year. There are some allocation requirements in terms of where KHRC needs to issue money. So for example, they need to issue at least 2.5 million to counties with populations of less than 8,000. So that theoretically influences the total they can allocate if they can't give that money to a qualifying county. And additionally, KHRC can carry forward its unused allocations to future years if it doesn't allocate the full $13 million in 1 year.
Thank you, Josh. Committee, any questions? Senator Peck.
Thank you, Madam Chairman. So I'm a little trying to track here. The affordable housing tax credit and the housing investor tax credit are different, but what is the difference? Is the affordable housing, I'm going to use the term for low income, and the other is for
other housing?
My understanding is there's no income link there, so that housing could be available for anyone. The affordable housing tax rate is also only for rental housing, whereas the housing investor one could be rental or owner-occupied units.
Okay, thank you. That clears it up.
And there used to be a restriction on, one was rural, and that was removed so that they can be used anywhere in the state, right? Both programs?
I am not familiar with that particular restriction.
That was a change, a legislative change. So committee will obviously be taking a deeper dive on this, but Josh, very much appreciated and good work. Thank you. Committee, is there any other business to be brought before us? I plan to work some bills this week. We'll let you know. Definitely Senate Bill 26. If we can get the data, the information we need on Senate Bill 25, we'll take a look at it too. Committee, we're adjourned. Thank you for your work.